What's up, people? Welcome back to Investor Clause. My name is Tevi, and this channel is dedicated to my investment journey, along with coverage on crypto, Tesla, Nio, Virgin Galactic, and ChargePoint. Come for the information and stay for the perspective. So a lot has happened this week. Tesla held its investor day and dropped some major news, ranging from showing progress on their robot Optimus, who now walks on its own and uses power tools, to officially opening up its supercharger network, which will add another revenue stream. This will likely warrant its own videos to share my thoughts. Nio, ChargePoint, and Virgin Galactic all held their earnings call this week as well. And at the macro level, the market went on a roller coaster ride, with initially dropping lower on the news that jobless claims came in lower than expected. The relevance here is that this means that the job market is still very strong. More people employed means more people spending, which means potentially higher inflation for longer. This then may cause the Fed to be more aggressive in their rate hike later this month and go with a 0.50 percentage point. That fear was put to rest when the Atlanta Fed president, Referral Links, said he was firmly in favor of a 0.25 percentage point hike, right? So that's good. That, in essence, is why the market recovered as we close out the week. As I said, a lot has happened this week, but in the interest of time for today's video, I'll go over the key takeaways from both the Nio and Virgin Galactic's earnings call, then take a quick look at the technicals and current analyst price targets to see if we can get a sense of where we are heading next. And I'll close with why I bought more of each stock. As always, this isn't to be taken as financial advice. I'm not a financial advisor. This is my personal approach to investing and a thought process behind it. I'd recommend watching all the way through so that you don't miss out on any pertinent information I'll be sharing. Drop this video an early like if you haven't already, and hit that subscribe button. Those are two easy ways to show support to the channel and help it grow if you appreciate the content. All right, let's get into it. Let's start with Nio. Last week I told you to expect a miss and that you should expect the price to move lower. Nio managed to close the week with a gain of 2.90%, but not before falling as much as 8.60%. Why? The results were even worse than anticipated. Lower revenue was a given based on the lower delivery numbers, but profit margins were hit harder than anyone could have guessed. Vehicle margin came in at 6.8% for Q4 2022. That's compared with 20.9% a year prior in Q4 2021 and a quarter prior with 16.4% in Q3 2022. Nio explained that it took a greater than expected 6.7% negative variance in the margin compression due to the inventory provision, accelerated depreciation on production facilities, and losses on purchases commitment for the existing generation of ES8, ES6, and EC6. But even if you assume that things had gone as they had hoped, this would have still been a short quarter, with margin at best hitting 13.5%. This still falls short of the year-over-year and quarter-over-quarter performance. On a go-forward basis, Nio expects to deliver between 31,000 and 33,000 vehicles this quarter. That too was a bit of a sticking point. It's lower than last quarter. However, when you consider that Nio delivered a combined 20,663 vehicles for January and February, this implies another 10,000 to 12,000 deliveries in March, which is respectable and a solid way to start the year. So my key takeaway is, despite the worse than expected results, if you look at the vehicle guidance and revenue guidance for Q1 2023, Nio still expects up to 28% in vehicle delivery growth and up to 16.5% in revenue growth, which is good in my book. Now, the initial shock of the earning results was enough to push us into oversold territory with an RSI of 28.56. The stock dropped as low as $8.50 intraday before rebounding. So in essence, we saw the technical bounce I predicted in last week's video, with a follow-through moving higher to close the week. The macro news certainly helped, but ultimately, investors recognized this as an opportunity to add on weakness. Analyst ratings and price targets were revised slightly lower. The consensus rating is still a moderate buy, but the mix is now 5 buy ratings instead of 6 previously, 4 hold ratings instead of 3, and still 0 sell ratings. That's important. The average price target has decreased to $15.64, suggesting a potential 63.43% upside from current levels. The high end of the forecast range is now slightly lower at $25. Previously, it was $28, and the low end of the forecast now comes in at $10 flat. Despite the slight revision lower, the bottom line here is this: upside is still expected, and that is the key. All right, so let's shift the focus to Virgin Galactic. Let me play you this short clip that does a pretty good job at summarizing the earning results. Take a listen.
Another name with earnings out as well, that is Virgin Galactic. I would note this is very much a pre-revenue company, so less than the EPS or net loss in this particular case, which was $151 million for the quarter. Less than those numbers of top line and bottom line. What's really in focus is cash position, which, according to the company, remains strong with cash and cash equivalents, marketable securities of $980 million as of December 31st, so down ever so slightly from where we ended 2022. The big thing and the focus here, because it is pre-revenue, is the space tourism business. And when commercial service is actually going to launch, Michael Colglazier, the CEO of Virgin Galactic, saying in this release that they are still on track to launch commercial service in the second quarter of 2023, and that enhancements to both the mothership, VMS Eve, which did a second flight yesterday, and VSS Unity, the actual rocket ship, are complete. So they are continuing on that path towards commercial service. You can see those shares are unchanged right now.
I think she did a great job summarizing those results and pulling out some of the key points. That would be the strong cash position and remaining on track for commercial launch. So why did the Virgin stock drop? The macro environment is the main reason. It was actually great to see that the 50-day moving average served as support and the stock bounced strongly off of it as the broader market rallied to close the week. A few other key points I took note of during the call that you should be aware of are as followed. Virgin Galactic is targeting a monthly cadence for their flights, but expect a wider interval between the first couple of commercial flights. This is to allow the technical crew to really get everything dialed in from a process perspective. Another one would be that revenue for the first 6 flights is expected to be around $600,000, which is a little bit lower, but the reason being that earlier tickets were only sold for $250K, so they need to work through that backlog. And also, Virgin Galactic will have one of their astronauts trainers on board of those flights to make in-person assessments of the cabin experience. The goal, of course, is to be able to recommend any adjustments to the training program. And after that, Unity will carry 4 passengers or research seat equivalents. And as a reminder, 4 is the total capacity seat that Unity has. Based on a mix of astronauts versus research payload, Virgin Galactic should be able to recognize somewhere between $1.5 million to $2.7 million per flight once they really get going. So it was encouraging to hear that the focus for 2023 is going to be on getting regular commercial flights going, and 2, completing the design for both the next generation motherships and Delta spaceships, as well as building the required tooling to begin the part fabrication for those ships. For the sake of time, I'll link the full transcript in the description below. There's some other good details in there, but this covers where the focus is for this year. As far as analyst sentiment, the consensus rating remains unchanged with a moderate sell. That said, the mix is now slightly different with 1 more hold rating. The breakdown is 0 buy ratings, 5 hold ratings, and 4 sell ratings. The price target range of $3 to $6 remains unchanged. Though we didn't get our first buy rating, we did gain a new hold rating, which is positive. Analysts are still skeptical given the long history of delay. Can't blame them for that. But I will say, management did a great job at projecting confidence on a path forward. We'll likely need to continue to see them deliver on each milestone to drive more positive sentiment from analysts. This then brings us to what I'm doing. I started the video by telling you that I've bought more of both stocks. The main reason is simple. Nio's growth story remains intact. Nothing they reported changed that story. The challenges they faced at the close of last year are already fading at the start of 2023. The picture only gets better from here, right? I've said that before. For this reason, I added a total of 250 shares, with most of them under $9, which makes me happy. Those shares are already offering some net positive returns in addition to helping lower my average cost to now $14.43. As far as Virgin Galactic, they gave the best update they could have provided. All ground testing and test flights to date have been confirmed to be major successes. The data reviewed is positive and confirms that the update made are doing exactly what they expect. We are now only 2 test flights away from commercial launch. This dip allowed me to add another 400 shares, dropping my average cost basis to $7.87. So heavy focus on my end to continue to lower my average cost basis as much as I can when opportunity like this presents itself. The last thing I will say is this. The market, generally speaking, has sold off a decent amount in the last 2 weeks as people took profit and are taking risk off the table ahead of the next CPI reading. For your reference, that inflation data point drops on March 14th. A week after that, we have the FOMC meeting with the decision on what is likely to be a 0.25 percentage point increase. The SP 500 was able to bounce off its 200-day support. The reason I'm telling you this is that we could see a bit more sideways action leading into the CPI reading. That said, If we see inflation cool off and we get the anticipated 0.25 percentage point increase, the market is likely to push higher once again. Buying on these dips, in my opinion, is the key as we continue this choppy uptrend. But on that note, that is it for me today. I know I went through it all fairly quickly, so if you have any questions, drop them in the comment section. Unless something super crazy happens to the other stocks on the channel, I'll more than likely dedicate next week's video to catching up on ChargePoint. If you found value in my content, click that like button and share with others who you think could also benefit from it. For my newcomers, subscribe, it's free. And don't forget to ring the notification bell so that you too can stay in the know. I'll be back on Sunday for my weekly video. Till then, you can keep up with me here on Twitter for crypto and NFT related news. Thank you for watching, stay humble, hustle hard, and I'll see you in the next one.